All right, so we're doing an example. Sorry, I forgot to start the recording. So we're doing an example, review this real quick, of a hospital, new hospital build. We bought land for $1 million. The building cost us $50 million. So our gross PPE account is $51 million, the sum of the land and the building. However, we don't depreciate land. We only depreciate buildings and equipment. So we took the $50 million cost of the building, divided it by 39, which is the useful life according to the IRS for buildings, to come up with an annual depreciation expense of $1.28 million. So when we, so at the end of the year, we will have taken a $1.28 million depreciation expense. We then have accumulated depreciation after 1 year of 1.28, whatever it was, 50 divided by 39. I'll be a little more. So 1.28205.1. So accumulated depreciation at the end of the year, right, gives us our net PPE. So we would take 51 minus the 49, 717, 949 roughly. So notice I could have picked a bigger number for land. I should have picked maybe 10 million, so there would have been a more pronounced difference. If I had included the 1 million of land, then the depreciation expense would have been based on 51 million, right? So we would have had a 1.3 million per year depreciation expense instead of a 1.28 million per year. My point being that we don't depreciate land. So land just gets carried at its historical rate. The thing that gets depreciated is the buildings and the equipment. Right? So every organization, not every, but a lot of organizations own land, right? And then they own a building on the land. So hospitals, if we talk about hospitals, large clinics are going to own land, and then they're going to have buildings on top of the land. The land value, gets carried at its historical cost. So like I was going to say, Exeter Hospital, the hospital itself was built in the 50s, right? That land, like I said, was probably out in the middle of the woods someplace, in a cow field when they bought it. Now it's in the middle of town, right? So the land that that hospital is built on is much, much more valuable, right, today than it was, 60 or 70 years ago when the hospital was originally built, okay? But they carry the value of the land at the 1950s value. So they probably bought it for, $50,000 or something. Today it's probably worth, 10 million or something like that. I don't know, I'm just making up a number, but it's way more than it was back in 55 or whatever it was. Come on. And so when you sell, right, if they bought it for $50,000 and they sell it for $10 million, when they sell it, it's going to be a non-operating gain because they will get 10 million. Their basis, and we'll talk about this more later on, what we call their basis in the land would be the original purchase price. So you take the sale price minus the purchase price, and that gives you this gain that they have to recognize. Now, the good thing for an organization like Exeter is they don't then have to pay taxes on that because they're a not-for-profit. But they do recognize it as a gain when that happens. Okay? Yes, Taylor.
And will useful life be provided?
Yes, I will tell you that. Yeah, because the useful life, there are depreciation tables. You can look up IRS depreciation, for different categories of equipment, and it will tell you, like a vehicle is a 7-year useful life, and a building is a 39-year. I don't work with it often enough to remember which they are, but they are dictated by the IRS in terms of when you take accounting for them. Right. If you have a responsibility for doing this, it will probably be in your computer program. You won't even have to. You'll be like, that's a pull down. This is a vehicle, and it'll just automatically do all the calculations, right? So, but we're doing this conceptually so you understand how this works. But yeah, in the real world, the accountants don't even, they're just like, okay, that's that category, and the computer program already knows. Divide that by 39, And actually in real world, we'll get to probably next semester, we'll talk about some of the other ways that depreciation is calculated, such as double declining balance and things like that. Even there, we're not going to spend a huge amount of time on it. Okay, I wanted to show this because we talked about it and I didn't want it to be totally confusing, even though maybe it still is. The key here is to understand you have, so setting aside the question of land, that's just one particular thing. Most of the stuff we're going to deal with, unless it's land, I guess this is the exception to remember, unless we're talking about some combined package of a building and land, you could basically just take the historical price of the asset and divide it by its useful life, and that will give you the depreciation expense per year, okay? Unless it's a building on top of land, at which point you have to take away the land value, all right, and just focus on the building value. I've never asked that on an exam because I don't want to make it any harder than it already is, right? So I probably won't ask this of you guys. I'm just bringing it up because I don't feel like I did a good job explaining it last time. Hopefully this is a little clearer. Okay, but the main thing to take away from this is when an organization buys an asset, whatever that asset is, except land, right? You're going to have a gross PPE value. Even with land, you're going to have that gross PPE value. You're going to depreciate it. So everything you own except for land gets depreciated. There is some useful life that each asset is going to have that you're going to divide the purchase price by the useful life to get your annual depreciation rate. This is called straight line depreciation. There are other ways of doing depreciation. I'm not going to ask you about them for this exam. I just want you to kind of have the general concept. There are more complicated ways of doing depreciation. We'll get into those probably next semester. So for now, for chapter 4, that's enough to understand. So then you would have your gross value, which in this case was 51 million. You're going to have a depreciation expense that is, the annual depreciation for each year that it happens. So after 1 year, we would have 1.28 million in depreciation expense. We would subtract the accumulated depreciation from the gross value to give us the net value. After the second year, on the income statement, we would have the same depreciation expense next year, but we would add that second 1.28 million to the original 2.8 million, which would get us what 2.5 something million in accumulated depreciation. We would take 51 minus 2.5, and that would get us 48.5 in net PPE, right? And then in the third year, we would take another 1.28 million. 2.5 plus 1.28 would be about we're in about 3.8 million. So accumulated depreciation would go from 1.28 to 2.5 to 3.8, right? This number just keeps on getting bigger. This number doesn't change, and so we keep subtracting. We take the gross, which is a historical basis, minus the accumulated depreciation to get the net PPE. So each year that goes by, the accumulated depreciation gets bigger, the gross stays the same, and so the net PPE is going down. The reason it's going down is because we're using that asset up, right? Over the course of time, we wear out that building. The doors stop closing properly, the plumbing breaks, all that kind of, that's what's represented by depreciation, is the thing is wearing out, right? That's why we use depreciation. So at some point, the building is worthless, right? And that's always kind of weird to see. Like you've got this, what appears from the outside to be this perfectly good building, and suddenly they're knocking it down and building a new building, right? Back when I was CFO at a facility in near DC, the hospital I worked in that to me seemed perfectly useful, they decided it was too old and wasn't worth, they wanted to, there was a need to expand the capacity of the hospital, and they looked at it and they said, in order to improve the hospital, we would have to do so much work to fix the HVAC, the heating and cooling systems and air handling. We would have to do so much because the hospital had been built in the, 60s or something. And so, there wasn't at that time the kinds of regulatory requirements for building. But there was also no internet. And so back in the 60s, everything was on paper. Well, now everything's on, electronic. So you need to have the cable plumbing, right, to handle all the electronic health records and all that stuff. The cost of retrofitting that building to 2010 standards at that time, was going to exceed the value of just knocking it down and building a whole new one, which from, kind of standing outside, you're like, it's like a perfectly good building. The problem is the guts of the building were so old and just so out of touch with, or not up to speed with what we needed. It just made more sense to just knock the whole thing down and start over. So that's what happens, right? But then the land was still there, right? The land didn't go anywhere. Okay. So that, I just wanted to touch on that because I feel like I did a lousy job explaining it. So, let's see. Where were we? So today we've covered the basics of the balance sheet. So now I want to talk. We talked about this. Okay. I need to talk about one more statement, and that is the statement of cash flows. And I'm going to very briefly talk about this. I may have a couple of simple questions on the exam for you. You need to be familiar with the idea. It's an important idea, statement of cash flows. It is an important idea. In a more advanced class, we would get into the calculations that go behind this. What the statement of cash flows does is it reconciles our accrual accounting to cash accounting, okay? So we talked way back at the, chapter 1 and 2, we talked about the difference between cash accounting and accrual accounting. And the difference being cash accounting, all the transactions get recognized when cash changes hands. When we pay for something, we write it down. When somebody pays us for something, we write it down. That's cash accounting, right? That's your babysitting business, your dog walking business, something really simple. That's not how healthcare organizations mostly operate, right? We recognize revenues when we render the service, even though we might not get the cash for the service for 30 or 60 days, right? So, and likewise, we order supplies and receive them, right? And start using them, and we might not be paying for them for 30 days, right? So those are all values that we're recognizing on our income statement and balance sheet that don't represent the true status of our cash. Organizations can look like they are healthy if you look at the income statement and the balance sheet, right? They can look like they're healthy and then suddenly not be able to pay their bills because their cash balance is out of whack, right? Because it's, maybe they have a bunch of receivables, right? Receivables are for healthcare organizations. I've seen patients, I've sent out bills, and the insurance company just hasn't, the insurance company hasn't sent me a check yet, right? If I haven't received those checks and I've got, Samantha and Taylor working for me, Samantha and Taylor expect to be paid on Friday, when payday is, right? They expect to be paid. They don't really care what my accounts receivable is, right? They just want to be, they're like, boss, pay me, right? And so the statement of cash flows is an important statement that reconciles a lot of these transactions to give us a more accurate picture of how much cash the organization has. So there are 3 components to this statement that tell how much cash the organization actually has available to it. And like I said, it reconciles the accrual accounting and the cash basis accounting. So it starts with, there are a couple of ways to start. The way our book starts, it starts with operating income. So the first section is, cash from operations. So there are 3 sections. The first section is cash from operations. operations. So we start with whatever operating income was. So operating income, remember, is operating revenues minus operating expenses gives us operating income. Then we start making a bunch of adjustments. We add back depreciation, right? So we're trying to get to the amount of cash that the organization has on hand. So if I take my operating income is my operating revenues minus my operating expenses. One of my operating expenses is depreciation. Depreciation is not a cash expense, right? It's a way, kind of a placeholder that we put on the income statement to represent the economic value that we've used up in a period, but it's not actually cash. Like that expense, unlike say the amount of money we spent on supplies, that's a real expense. Like we really wrote a check to Claire's, medical supply company, right? But depreciation is a theoretical expense that we aren't actually writing a check to anybody, but we still put it there to represent more accurately the amount of resources used up. So when we're trying to get to an actual picture of cash, we have to take out anything that's non-cash. So in this case, depreciation reduced our operating income. So in order to get the operating income closer to its actual cash coming in, we add depreciation back. MSI hand. This start. And that doesn't really need to be there. It's kind of talking and writing at the same time. So that's not part of the statement. That's just, so it starts with operating income, and this is cash from operations, right? So we add depreciation. So if we had $1,000 in operating income and we had $100 in depreciation, we would add the $100 back to get $1,100 because that depreciation that we took as an operating expense artificially reduced our operating income, or from a cash perspective, artificially reduced our operating income, right? So we add that depreciation back. With accounts receivable, right? If we have an increase in accounts receivable, so accounts receivable is this account, right? Remember, so accounts receivable is the amount of IOUs we have from insurance companies. So it is not the amount of cash we've received. And so as we go along, and this is the important thing, one of the important things about the balance sheet, right, is the balance sheet, remember, is a snapshot in time. So it is balances of all these different accounts. So we have the operating, as we're operating our hospital, we have, we're sending out bills, and as we send out bills, the accounts receivable goes up. We're simultaneously sending out new bills, and then the insurance companies are sending us checks paying off those bills. So we're simultaneously sending out new bills, and the accounts receivable is going up, and then we're receiving checks from the insurance company, and the accounts receivable is going down because the IOUs are getting paid off. So there's like this kind of simultaneous going up and going down at the same time. And so if you think about the metaphor that's often used to describe these kinds of accounts is to think about a bathtub. So when you take a bath, right, you turn on the faucet and water starts coming in the tub. And if you put a plug in the drain, the water starts to rise, right? So imagine that that's kind of like us sending out bills, right? So our accounts receivable is the tub, right? The water level in the tub is the amount of accounts receivable that we have. We turn on the faucet, water starts pouring in. That's like us sending out bills. So the water's coming up, right? If we pull the plug now, so like let's say the water gets up to a certain level, we now pull the plug, right? Depending on whether the faucet's running faster than the drain, the water level will either keep going up or start to go down. Or if we have the faucet set to exactly the same rate that the water is draining out, we'll have a constant level, right? It's very much like accounts receivable, right? We're sending out bills, that's the water coming in. We're getting bills paid off by the insurance companies, that's the water going out. And those actually don't stay constant all the time, but there is kind of like a general level where you would expect to see the accounts receivable kind of staying at. And it's going to go up and down a little bit depending on, different transactions. But so an organization typically has some level of accounts receivable. And if the accounts receivable now goes up, what that tells you is the accounts receivable is increasing faster than the bills are being paid off by the insurance company. So it's the amount of bills we're sending out is increasing faster than the cash is coming in. And it could be because we're doing more billing and the cash coming in is at the same rate, or it could be that the cash coming in has slowed down and we're doing the same amount of billing. So the question was, do we want our accounts receivable to be low? Actually, yes, right? So there's a whole art to, this is called revenue cycle management, RCM. And there are companies out there that sell this service, one of which has just started doing internships with us, right? And so revenue cycle management kind of, you don't ever expect it to go to zero because that's not how we operate as an organization, right? We're constantly sending out bills. But a well-run revenue cycle management operation, RCM operation, is going to keep that balance relatively low because we want the cash to come in as fast as possible, right? If for some reason our AR starts to rise, that means that we're not doing a great job chasing after the insurance companies and saying, hey, pay us. You said, we took care of your patients, you need to pay us, right? This is the challenge that organizations have. And you can wind up running out of cash. So you're never going to get to zero because of the nature of our business, right? The nature of our business is we send out bills. And so you're never going to get to zero. It's actually measured, it's measured in a dollar amount, and then it's measured in a number of days of accounts receivable. And we'll get to that in another chapter. But the goal is to kind of keep it as low as you can because that means you're getting your cash faster. You're in this cash cycle, cash generation cycle, and you're getting it faster. Yes, Em?
So we did last accounts payable or is that 30 days?
No, typically not, but you could. Yeah, as far as I know, hospitals do not provide any sort of discount to, I've never heard of that. But that's, typically that's done by suppliers, typically not done by service organizations like.
What the value of the service was?
Sorry?
Because you would want the full value.
Yeah, I mean, and so yes, we want the full value of, so we don't typically, so the question was, do hospitals offer discounts for paying, for quick payment? As far as I know, I've never heard of that being done. But I mean, I guess it's possible that somebody does, but I don't think so. So yeah, good question because you're applying the same logic. Okay. So if accounts receivable goes up, that means our cash level is actually going down. So if AR goes up, right, we would reduce cash. And then if AR goes down, then we would increase cash. So this is a little funky. I'm not going to ask you this on the test. I just want you to have a sense of what it is. So, I mean, keep writing it down. Just, I don't want you to totally stress about it. If we have an increase in inventory, what happens to our cash? And think about it this way. In order to increase my inventory, what do I have to do? I have to spend cash to buy the inventory. So if my inventory goes up, my cash goes down, right? So if inventory goes up, my cash is going to go down. And it's going to go down, right? I'm going to reduce the operating income by the change in inventory. So if my inventory level went from 1,000 to 2,000, up to 2,000, my cash levels would go down by the difference, or 1,000, right? 2,000 minus 1,000. There was an increase of $1,000 in inventory. In order to get that additional inventory, I had to spend an additional $1,000 in cash. So that's the thinking that we go through as we make these adjustments. If we have a increase in accounts payable, how does that affect our cash levels? So accounts payable means the number of IOUs that we have out there that we have to somebody else, right? An accounts payable is an IOU that we owe to somebody else. An accounts receivable is an IOU that somebody needs to give to us. So we have our accounts payable goes up because we've ordered stuff and we haven't paid for it yet. So what does that mean? How would an increase in our accounts payable affect our operations?
We're gonna have the stuff, but we're gonna have the cash too.
Right. Right. So Emma said, we're gonna have the stuff and we're still gonna have the cash. So, but because we're on an accrual basis, we've already charged ourselves for the expense of buying the stuff. So but we haven't paid for it. So our operating income understates the amount of cash we have when our accounts payable goes up. So if our accounts payable goes up, we're going to increase our operating income by the amount that our accounts payable have gone up. I know this is a lot of kind of head twisty kind of stuff. Again, not going to ask you it on the exam, but you should have a general idea of how this works. And there's a couple of other adjustments. That gets us to our net cash flow from operations. So all of these things are related to the operation of our organization. So that is say, part one of the statement of cash flows. Now, on the exam and in some of the problems you probably already did from chapter 3, I think, there's at least one question that says something to the effect of estimate the cash flow for an organization, right? So you've seen this problem already? Okay, so it says something like, the organization has net income of $10,000. It had depreciation expense of $1,000. What is its actual cash flow? You would add back the depreciation expense to the net income, and that gives you an estimate, right? A very, very rough, oversimplified estimate of how much cash the organization actually brought in that year. Okay, so your most basic rough estimate of cash flow is going to typically be, I'm going to glance at the net income, and then I'm going to look up into expenses and say, okay, the one thing that I can point at that I know is not a cash expense is depreciation. And it's usually a pretty big number relative to the organization, because hospitals and nursing homes and clinics have a lot of equipment, right? And buildings that are expensive. They're really expensive, particularly like nursing homes. Nursing homes are super high in terms of their PPE. Nursing home is a building where people live, right? So their depreciation tends to be a very high share of their operating expenses. But it's not a cash expense, right? And so if you want to estimate how much cash did this organization have, you can look at their net income, or how much do they bring in that period. You can look at their net income, add back the depreciation. It gives you a very rough estimate. Now, to get a more accurate estimate, you've got to look at all these other cats and dogs too, right? But the big dog is going to be the depreciation almost always, right? These are going to be mostly going to be fine-tuning. Okay, so the first section measures the amount of cash that comes in from operations. And so we then get net cash flow from operations. The second section is cash from investing. Okay. So with cash from investing, we're going to have, and this is where So capital expenditures is the first line I'm putting here. So if we have an increase in capital, and when we use the word capital, when we're talking about an organization and financial accounting, we are talking about physical stuff that the organization is buying. So we have an increase in the PPE value, right? The property, plant, and equipment, not the personal protective gear, but the property, plant, and equipment. If we have an increase in property, plant, and equipment, what has happened to its the organization's cash, all other things being equal? Setting aside how it's financed, because we'll get to that in a minute. If an organization buys a new truck, what would happen to its cash balances? It would go down, right? You have to give cash to the dealer, right, to buy the truck. An increase in capital expenditures results in a decrease in cash. We would either add, here's where we would throw in other non-operating income. And that would either be plus or minus depending on whether it was, if you had a non-operating gain, that would go here. If you have, and that's usually here because you're buying and selling something and it's not part of it's considered investing, it's not part of your core business. So if you had an operating gain, non-operating gain, because you sold a piece of land for a gain, that would be a change in investment. It would decrease the amount of PPE that you would have. So that means that causes an increase, and then you would have this gain. So if you bought the land for $1 million and 20 years later you sold it for $10 million, you would have a $9 million increase in non-operating gain. You would also have $1 million increase in capital expenditures because that you've sold $1 million worth of property. So your property value went down. That inverts this, and it gets kind of crazy. Okay, so we've got that. If you purchase short-term securities or long-term investments, right? What happens to your cash levels? These are not physical things. These are your good, right? So just think everything held equal, right? What do you have to do? If you're going to buy CDs, right, because you want to take your money out of your checking account and put it aside for a bit, you've got to take money out of your checking account and give it to the bank. That's a decrease in your cash flow. If you're going to take big money out and invest it in long-term securities like stocks and bonds because someday you're going to use that money to build a new hospital, that's also a decrease in cash. Doesn't mean that you're lost the money or it's anything bad. It just means you don't have it in cash anymore. You've taken it out of your checking account and put it someplace else. It's a decrease in liquidity. Right. In cash. This whole statement is just about your cash, right? But Emma makes a good point. I'm taking, almost by definition in this section, I am taking cash and I'm moving it to something less liquid, right? Why do we care about cash? Because that's the blood of our organization, right? It's how we pay our bills. Okay. So a purchase of short-term securities brings it reduces your net cash. A purchase of long-term securities reduces your cash. Likewise, the sale of short-term securities or the sale of long-term securities increases your cash because all other things, ignoring everything else that's happening around your organization, that individual transaction would cause an increase, right, in cash. That gets us to net cash from investing. And then part 3 is cash from financing. which is different than cash from investing, okay? Cash from financing, so let's say we buy a new truck, right? We're gonna go out and buy a new truck, it's $50,000. We could write a check for $50,000. Most of us don't have $50,000 in the bank account. We could write a check for $50,000. More likely what we're gonna do is write a smaller check for, say, $10,000 and take out a bank loan, right? So if we did that, our PPE would go up by 50,000, which would cause our capital expenditures to go up, which means that our cash flow goes down by 50 up here, right? We would on the we would look at then we would look at the loan that we took out, and if we have a bank loan and the bank loan increases, then cash from financing increases. So we had 50,000 goes out, right, to pay for the truck, but we took a $40,000 because we had a $50,000 increase in PPE. So that drives our cash flow down by 50,000. But then we got $40,000 in cash from the bank to pay for the truck. So that brings our cash flow back up by 40. So the net effect, right, was minus 50 up here, plus 40 down here. So our cash flow is really only down by minus 50 plus 40, minus 10, as opposed to minus 50. They're just happening in different parts of the statement. So when I was talking earlier about, holding everything else equal, what happens if I do this, right? You think, okay, cash, how does it affect cash? Well, if I, buy short-term securities, my cash has to go down. But maybe I borrowed money from the bank. It'd be dumb. But if I borrowed money from the bank in the same amount, right, it could create a wash. Meaning I could, if I was to, well, in this case, if I bought, a better example is buying the truck, right? I buy the truck, that drives my cash down. I get financing from the bank on this part of the statement, that drives my cash back up again. Okay? So bank increases in bank loans increase the cash from financing and increase the organization's overall cash levels. You can have other kinds of long-term debt. As well as, so if I increase my long-term debt, so if I issue bonds, which we'll talk about a lot more later on, if I issue bonds, I'm getting a loan from the market as opposed to a loan from an individual bank, right? That means cash is coming into my organization. Chances are if I'm issuing bonds, I am using that money to build something big, like a new building, like a new hospital, right? So I float a $50 million bond issue because I need $50 million to build my new hospital, right? So new hospital would be, up here would be, building the building would be $50 million or however much money the building is. That would cause that would be cash from investing, and that would be a negative because I'm increasing the amount of PPE I have. And so there's an inverse, effect, meaning I've got to flow $50 million out of my organization, but at the same time, I issue bonds for $50 million, and so cash comes into my organization. So at the end of the day, once those transactions are done, there is a zero effect on my cash balances, right? Because I spent 50 and I got 50 loaned to me, so those wash each other out and the zero effect, right? All right. Lauren gets it, so that's what. Okay, so that, another example of that could be if you were a for-profit, you could have an increase in common stock. What does that mean? Well, Krista could, maybe Krista has a company, right? She runs a medical supply company, and she says, hey, Sam, would you like to, be part of my company? And Sam says, yes, I'd like to, buy into your company. Krista says, okay, you can buy in. If you give me $100,000, you can be a 10% equity shareholder in my company. So when Samantha gives the company, not Krista, but the company, $100,000, the common stock increases, and so that's additional cash available to the organization. So those all net out to net cash from financing. So what do? At the end of it, we add the three net flows together. We start with the net cash flow from ops, we add the net cash from investing, and we add the net cash from financing, and that gives us our change in cash on the cash flow statement. So we have the three sections are netted together. So we have cash from operations, cash from investing, cash from financing. It gives us net change in cash. And then we look at the beginning cash balance. So we go to the balance sheet and we say, okay, this cash flow statement is over a period of time. So at the beginning of the period, say January 1st, we had a balance of $100,000 in cash. We had a net change in cash of, say, an increase of $100,000. So our ending cash is our net increase in cash over the period, plus our beginning cash gives us our ending cash. Okay, so it's basically, how much did you have at the beginning of the year? Okay, how much cash did you bring in over the course of the year? Okay, let's add the amount of cash we brought in over the course of the year to the amount that we had at the beginning of the year, and that gives us the amount at the end of the year. It's pretty straightforward and intuitive, right? If I had $100 in my bank, I earned $100, and I didn't spend any of it, right? At the end of the year, I would have $200. That's all this says. So this is the statement of cash flows, super simplified and super fast. The main thing, the main kind of thing that I'll ask you about on this exam is not to build a cash flow. You need to be familiar with this concept. And you want to have the intuition of, if I'm spending cash on something, my cash is going down. If I'm receiving cash in, my cash is going up. And it could be from a variety of things. It could be spending it on supplies. It could be spending it on equipment, right? It could be spending it to pay off old loans. It could be earning it in the form of, bills sent out for services. It could be earning it in the form of selling old, land. It could be earning it or bringing it in, not earning it, but bringing it in and through getting new loans. Those are all ways that we could have cash coming and going. The thing that you need to remember how to do is that super simple back of the envelope, which means like a really simple estimate. Basically, net income plus depreciation equals very rough cash flow. And there will be a question like that on the exam. And you want to remember, that's not really the cash flow. The cash flow statement is really a lot more complicated than that. This is like a super oversimplified, estimate of just glancing at the income statement. You can kind of get a sense of what the net cash flow was over the course of the year. All right. So for the balance of this time, we're going to talk about balance sheet transactions. This gets a little hairy, and a lot of folks get a little confused. So there's lots of examples on the old exams. There's a bunch of problems, and there's some examples in the textbook, and there are examples textbook. There's at least one, if not more, problems that deal with these balance sheet transactions, and then on the exam there will be some sort of balance sheet transaction question. So you want to get a handle on this. All right. What do I mean by balance sheet transactions? Well, everything that happens on the balance sheet has to be balanced, right? We've been using this idea of a scale. So if something happens on the asset side, something has to happen on the owner's equity and liability side to balance them out, right? So if for some reason the asset side goes up by $100,000, so we buy a piece of equipment, for example, something has to happen on the, because, so we buy a piece of equipment, that means PPE goes up by $100,000. We have to, on the owner's equity and liability side, has to go up as well in order to balance that out. So basically what we're saying when we do that is we say, okay, we bought something, it goes up by, the asset side goes up by 100,000. It must have been funded in some way, either by liabilities, meaning we took out a loan to buy the thing, or owner's equity. The owners contributed some money to buy the thing, right? Or there's some other ways we'll get into a little more detail. But let's start with a basic, let's start by starting our business. So Emma wants to start a business, right? Emma and four of her fellow radiologists decide to start a business. So this example is investment by owners. So this is going to be a for-profit example. So we have 5 cardiologists, right? Create a new corporation and contribute $200,000 in cash. How does this affect the balance sheet? Well, there is no balance sheet to begin with, right? Because it's a brand new corporation. So it's 5 cardiologists. They've contributed $200,000 in cash each. Okay, so cash. What is cash? Is it an asset, a liability, or an owner's equity? Can you touch it, spend it, or sell it? It's an asset, right? If you can touch it, spend it, or sell it, it's an asset. So 5 cardiologists contribute $200,000 in cash each. So we have on the asset side, I'm going to abbreviate assets as A, right? On the asset side, we have cash equal to 5 times 200 or $1 million. Okay. So now we have on the asset side, the scale has gone way down. So we've got to do something to balance the scales back out. So that means we've got to do something over here on the liability and owner's equity side. So if I have contributed $1 million in cash to start my business, we talked about what goes over here. We've talked about how that gets defined. What account increases on this side to balance out the $1 million on the cash side? Aaron?
Wait, what did you say? Sorry.
No, okay. Now you look like you were going to raise your hand. So I've got cash contribution from my investors. What do I do over here? Is that a liability or is that owner's equity? It's owner's equity. Good. Okay. Why is it owner's equity? Because it represents there's no loan here. They've all contributed money to create this business. So they each own 20% of the business. So they each own that. That money is accounted for in a common stock or accounted for as common stock. We're going to abbreviate that CS, and that's going to be 1 million. So now we have on the left side $1 million and on the right side $1 million. So now we're in balance. Now let's say they've got cash. You can't do anything with cash, right? I mean, you could spend it, but you can't operate a business with just cash. So they've got to buy something. So they're going to buy equipment for $200,000 in cash. So what happens? We're going to buy equipment. So on the asset side, I now have PPE of 200,000, right? Because I bought equipment. And I bought it with cash. So what else happens to my balance sheet? So we haven't, so depreciation will happen eventually, but at this point we've just bought it, so there's no depreciation yet. Something has to happen simultaneously. So what has happened now is I was balanced. I now have $200,000 in property. So that means that the left side is heavier than the right side now. So something has to balance that out. Does something happen on the right side, or is there something else happening on the left side? So I bought it with what? Cash. So the cash balance goes down. So PPE goes up by, let's just call it plus 200, and cash goes down by 200. So we have a cash balance now of 1 million minus 200, or 800, and we have a PPE balance of 200. We add those together and we have 1 million, right? And our liabilities and owner's equity, no change. Common stock, still 1 million. Converting to thousands. No change. Yep, it'd still be common stock 1 million. No added line. Not for this transaction. So we're not building a, I mean, I guess I kind of built a true balance sheet here. What I would want to see from you for a question on this exam would be, if I buy 200,000 in equipment, what happens? What are the effects on my accounts? The effects on the accounts are cash goes down by 200 and PPE goes up by 200. To build the balance sheet, you would say, okay, cash account is now 800, PPE is now 200, totals up to 1,000. Common stock, no change, stays at 1,000. So that's transaction 2. Transaction 3. They purchase supplies net 30, and they purchase 20,000 in supplies, $20,000 in supplies. The K represents thousands, just in case that's not ringing. You're not familiar with that annotation. So a lot of times I'm going to say 20K or 50K, or I'll say 3M for 3 million, right? So just kind of get used to that, that annotation. M for millions, K for thousands, right? So if they purchase supplies net 30 for 20K, what are the transactions happening? And then we'll look at the actual balance sheet. What happens? So supplies. Okay, it's not PPE, but you're right, you're on the right track. Inventory, good. And inventory is why is it not PPE? It's going to be good. It's not PPE. PPE is stuff that lasts at least a year, if not longer. Supplies, stuff like syringes, are going to be used and thrown away. So those are what kind of assets? What's the category? PPE is a long-term asset. Short-term current asset is the formal term. Current assets, right? You can think of it as short-term, but the proper terminology is current assets. So current asset, so it's a current asset and it's inventory. So, or supplies. If you said inventory, right, plus 20K on the asset side, I'd like you to be able to identify it's a current asset, inventory. So that would be, I'd like to see something like that. Okay, and it's net 30, so what does that mean? 30 days, they've got what? They've got 30 days to pay it. So They've received $20,000 worth of supplies. Does cash go down to like we did a minute ago? What happens? Okay, so Emma's saying no, cash doesn't go down. She's correct. What does change? A short-term or current liability, good. Current liability, and what kind of current liability is it? Accounts payable, not receivable, payable. Big difference, right? It's the exact opposite of each other, right? They're easy to get mixed up because they sound the same. Accounts payable is an IOU that you owe, and account receivable is an IOU you are owed. Okay, so this is going to be accounts payable plus 20. So they both sides increase by 20,000. So this is a short-term loan of 30 days, right? So it's an account payable of plus 20. So if we were to build the balance sheet now, we would have cash of 800, right? So our current liabilities, we have cash of 800, inventory of 20, current assets, thank you. Current assets of cash of 800, inventory of 20,000, for total current assets of 820,000. Then we would have PPE long-term assets of 200,000 for total assets of 820 plus 200, 1020. On this side, liabilities and owner's equity, we have current liabilities of 20,000. So total liabilities of 20,000. And then owner's equity, current stock, 1,000 for a total liabilities and owner's equity of 1,000 plus 20, 1,020. Okay. And they're balanced. Right? All right. Next. You want to put it up again? Okay, so next, they're cardiologists. So they start seeing patients, right? They see patients and they send out $50,000 in bills. All right, $50,000 in bills. How does that affect the asset side? Accounts receivable goes up by $50,000, right? Why is it accounts receivable and not cash? We've billed the insurance companies, but we haven't gotten the cash yet, right? So, transaction 4, services rendered, 50K. So, these are billed out. So the asset side, accounts receivable, increases by 50,000. Here's where things get a little hairy, all right? What's going to happen, and I'm just gonna, is no impact on liabilities. This is gonna flow through, and now you have to think through the flow-through effect from the income statement. So our income statement, if we picture our income statement, right? We have revenues of, at this point, $50,000, right? I haven't told you any of the expenses, so we can ignore the expenses for now. For this particular transaction, let me reframe that. For this particular transaction, I have not told you about any expenses. So if I'm running through my income statement, I've got revenues of 50. I didn't tell you about any expenses. So I have essentially net income of 50, right? And now we need to remember our changes in statement of changes in owner's equity. Statement of changes in owner's equity starts with net income. We subtract dividends. I haven't told you about any dividends, so there's no dividends to subtract off. That becomes retained earnings. So 50 minus 0 is 50. Retained earnings, if you remember, is the other equity account for for-profit entities. So retained earnings, so we'd have owner's equity, retained earnings of plus 50,000. So what we've done is we've had to hold in our head, all right, we've got this transaction, we've provided care worth $50,000. We haven't received any cash yet, that doesn't matter at this point, right? So running through the income statement, we have a very simplified income statement, revenues of 50, no expenses mentioned up here. So the net effect on net income from this additional 50,000 is an increase in net income of 50,000. Now thinking through the changes in statement of changes in owner's equity, which is net income minus dividends gives us retained earnings, right? We know that we've got an increase in retained earnings of 50,000. That is what flows over to the balance sheet as the retained earnings. So the retained earnings, and this is only part of this change of statement of changes in owner's equity, but it's the relevant part. So the retained earnings increases by 50,000. So summarizing this again, we have current assets, right? We have cash of 800, inventory of 20. We now have accounts receivable of 50 for total current assets of 800 plus 20 plus 50 or 870. We have our PPE of 200, so our total assets is 870 plus 200 or 1070. On our liabilities and owner's equity side, we have current liabilities, accounts payable of 20, and that is all our liabilities. So we have total liabilities of 20. We have owner's equity. We had common stock of 1,000, and then we have retained earnings now of 50. So we add total owner's equity of 1050. So we have total liabilities and owner's equity of 20 plus 1050, which is 1070. Right? And now these match. All right. Last one. Get back home because it's kind of a repeat. We now pay our accounts receivable, our accounts payable. We pay $10,000 toward the $20,000 in accounts payable. So what happens? On the asset side, if we're going to pay our accounts payable off, what do we have to spend? Cash. So current assets, cash is minus 10,000. And on our liabilities side, current liabilities, accounts payable also goes down by 10,000 because we've paid off the 10,000. So that reduces, I'm not going to do it out because I don't have time. That reduces this accounts payable from 20 to 10, right, which reduces our total from 1070 to 1060. It reduces our cash from 800 to 790, which reduces our current assets from 870 to 860, which then reduces our total assets to 1060. So we're back in balance again, right? One more. I'm really down to my last minute. we receive payment for our from our insurance companies. Let's say we receive $25K payment from insurance companies. What happens? So we get a check in the mail for $25,000. Good, goes down. You're in the right. Yeah. Okay. On the asset side, I've received a check in the mail. I deposit it into my bank. What happens? Cash goes up, right? At the same time, Emma and Allie were putting together, accounts receivable goes down by 25,000, and so we wind up, nothing happens on the right side, right? Because it's balancing out here. Cash went up, accounts receivable went down. All right. So if I was writing out the statement, I would rewrite, what I would do is cash would go up by 25,000, so I'd add 25, and the accounts receivable would go down. There would be a net wash here. There would be no change in the current. So you don't put the these are summary balances. So you would write, you're writing out your transaction here just to show me what's happening, but you wouldn't write, I'm not sure I'm completely understanding. Yes, on the right side, there's no impact. Yeah, because your cash would go up by, your cash balance would go up by however much you got in cash, 25,000. Your AR would go down by 25. So you would write the new balances here. But you wouldn't write like plus 25 over here. You would write, this would be 25 instead of 50. This would be 8, right? All right, very good. Read it over. We'll see you tomorrow. Tomorrow's